Hey everyone, Jeff Dorman, Chief Investment Officer at Arca, back for another edition of That's Our Two Satoshis Live, where we talk about what's going on in the digital assets market. For those who prefer to read rather than listen, we also publish a blog every week. You can find it on our website at ar.ca/blog. As always, before we get started here, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. Okay, so there's a lot going on in the market right now. And I think this was a pretty telling week because even though we've been in the camp, and for those who listen to us a lot know that we've pretty much thought the macro environment was not a big driver of what's happening in the digital asset market, really since the first quarter or maybe second quarter of last year. There's still a lot of people out there who still believe that macro is driving everything. And I think, even though there was barely a string to kind of hang on to there, or a thread to hang on to there. If there was, it got snipped last week, right? Because last week we saw pretty much everything going in opposite directions, right? You had the S&P was down, you had gold was down, you had treasuries were down, with meaning yields were up, you had the dollar back up. All the things that any macro investor would have said, well, that would have killed digital assets. And instead, of course, we rallied another 10% plus. A lot of people are stuck on the sidelines right now, right? You can see it with high cash balances. You can see it with just sentiment in general, with the way this market is viewed in the media and elsewhere. It's hard to get back into a market after it's already up 50 to 100% for the year. But, there's reasons why this rally is real and why it probably continues for a while here. Not just because of the macro decoupling, but also in the sense that if you think about what most people are pointing to for why this industry should not succeed right now, or why prices shouldn't go up, it's really mostly around the regulatory regime. And as we'll dive into here, I just don't think it's that relevant for prices, right? It's definitely relevant for the health and the long-term appreciation of this industry. But it's really not relevant for the prices of assets that exist today. So let's start with, in my opinion, we'll go through all 5 reasons that I think this rally is actually warranted. So to start with, number one, I think people are starting to understand that these tokens are pretty resilient. The old adage was always, I don't want to invest in tokens because they have no downside protection in a bankruptcy. Whereas, equities and fixed income give me that downside protection. And of course, what we're actually seeing is the opposite, right? The second half of last year was the worst year on record in terms of news coming out of this industry. But who suffered? It wasn't token holders. ETH was higher in the second half of last year. Matic was higher. Uniswap was higher. I mean, all the large caps were higher except for Bitcoin in the second half of last year. But what went to zero was your equity in the companies that support this industry. Your FTX equity, if you were an investor, your BlockFi equity, your Celsius equity, your Voyager equity, you name it. It was actually the equity of businesses that went bankrupt, where you're now going to get a zero recovery, that have the worst downside protection. And the tokens themselves are proving to be pretty resilient. So those who walked away from the second half of last year saying, oh, this industry is toxic, I don't want to touch it. Actually, you got to dig a little deeper there, because it's actually businesses and the equity of those businesses that are toxic, whereas the tokens themselves, from layer 1 protocols, layer 2s, DeFi, Web3, actually pretty resilient. So I think that is starting to sink into the market a little bit here. And as a result, you're just not seeing the mass selling of tokens on any news, negative news, or on any hiccup in the market. Second, we've talked about this in the past. I think of where we are in the industry right now as we're in the .crypto phase, just like we 20 years ago we're in the .com phase. And what we mean by that is the early .coms were internet native companies. They would not have existed if it was not for the internet. And it was only later, 10 years later, where traditional regular companies started building on the internet, right? Meaning the first wave of .coms were your eBay.com, Priceline.com, Amazon.com, Pets.com. And it was later where Starbucks and Disney and JP Morgan and Walmart started using the internet. The same thing is true right now of the cryptos, right? These are infrastructure companies. These are businesses and protocols and companies that would not exist if not for blockchain. As a result, what does an infrastructure company mean? It means you're very highly levered to users and transactions and volumes. When users and transactions and volumes are way down, like in 2022, prices are going to follow. Similarly, when all that stuff is up, users is up, transactions are up, and volume growth is up, you're going to see a pretty reflexive increase in prices. And that's just what you're seeing right now. I mean, in January alone, Average centralized exchange volumes were up 73%. Average decentralized exchange volumes were up 57%. Average decentralized derivatives exchange volumes were up 97%. You're just seeing users come back, right? We saw, if you look at Trezor or Ledger in terms of non-custodial self-hosted wallets, their volumes are way up. There's just a lot more interest in this space and usage usually translates into higher prices. So, that's a little harder to predict if that will continue or not, but it certainly, certainly validates some of the price moves that we've seen year to date. Third, I would say that, the U.S. regulatory attack on digital asset companies, which in essence is trying to further segregate, blockchain companies from traditional banks and brokerages, is actually proving to be more short-term bullish for token prices, which is an opinion that I've held for a couple of weeks and have shared it. I think others disagreed, but we're starting to see it, which is that when you see an attack on Kraken and their staking service, or you see an attack on Paxos and their stablecoin BUSD, or you see an attack on any specific company in this space. What you're starting to realize is, well, maybe I should just be in the tokens themselves of the protocols, which seem to be immune from where the attacks are. We already had one of the highest stablecoin dominance ratios ever. Almost 20% of the market was in basically cash stablecoins. And all of a sudden you're worried about your stablecoin or your stablecoin provider. You're better off in Bitcoin or ETH or in some other app or protocol. And you're just seeing that across the market right now, which is that this cash buildup and assets just being held on centralized companies is leaving, and instead people are just buying the assets themselves and holding them in their own custodial options. So I think that will continue. I mean, that's a trend that probably will continue for most of this year, and really accelerated at the end of last year in the wake of FTX. The fourth reason I think this is pretty warranted is that again, these attacks from regulators have not been on services themselves. They've been on the companies providing these services, right? It wasn't an attack on staking. It was an attack on Kraken's version of staking. It wasn't an attack on stablecoins. It was an attack on Paxos's version of a stablecoin. And what we're seeing over and over again is anytime you have an industry with perfect substitutes, when there's an attack on an individual player, there is no impact on price. That business just goes elsewhere. We've seen it over and over again. We saw it 3 years ago when China exited Bitcoin mining, and Bitcoin mining was, China had a 75% market share in Bitcoin mining, and it went to zero. There's no impact on price of Bitcoin or hash rate. Instead, other areas of the world just picked up the slack. Similarly, 2 years ago, BitMEX was charged by the DOJ. BitMEX at the time had a 40% market share of derivatives trading. Derivatives trading didn't go away when BitMEX's share went from 40% to 4%. It just went to Binance and FTX and to DYDX and other places. So you just see this over and over again, that in an industry that's global with perfect substitutes, there's just not an impact on price when individual players are targeted. And finally, the fifth and probably the most important takeaway from the regulatory onslaught, and why I think some of this price move is still warranted, is everything that's happening that's bad is really here in the United States. The rest of the world is still pretty bullish on blockchain adoption. We saw out of Hong Kong, basically legalizing digital assets. This is a global industry. As much as I like the U.S. and a lot of people live in the U.S. who talk about and invest in digital assets, in a global industry, I think the actions of the U.S. are just less important than the people in the U.S. think they are. And I think that will be a theme as well, as you just continue to see companies moving outside of the United States, token issuers moving outside of the United States, funds and developers moving outside of the United States. So I think this anti-fragility that we're seeing across the industry, across prices, is starting to really resonate with investors. I think the one area where it gets a little more confusing is with the SEC's proposal on the custody rule. I'll leave that to people who want to read the blog to read exactly what the details are there. But essentially, this is not just targeting the digital asset industry. This is targeting RIAs across all industries. But the interesting debate, in my opinion, is that it's basically trying to segregate where you hold your assets from where you trade your assets. And intuitively, that makes sense, right? You should have separation of where you trade from where you hold it. The problem is blockchain by definition is meant to be real-time settlement, where the whole point of it is peer-to-peer trading, and the blockchain rails basically allow you to instantaneously send and receive your assets. So you kind of have a conundrum here, right? Which is that if you want blockchain finance to succeed, you can't really separate where you hold the assets from where you trade them, right? What the SEC is effectively saying is, if you want to trade, you can't do it through blockchain rails, right? Because what we need to do for blockchain rails is you basically need to either hold your tokens where you trade them, i.e. an exchange like a Binance or a Coinbase, or two, you need to use self-custody and transact via DeFi, right? So meaning like a MetaMask wallet or your own cold storage wallet. Or three is you need to hold your assets with a custodian and then settle them and trade them and settle them later OTC, right? Using a service like what Cumberland offers or what Galaxy offers. All three of those are really kind of basically telling you that we want a T+0 system. We want something where you can settle and trade instantaneously. But what we're used to in the traditional debt and equity world is T+1 settlement, T+3 settlement. So I think this is the biggest gap and the biggest confusion point. That is, if the SEC really goes down this road of trying to push through this custody rule, and again, this is going to be 18 months to 24 months away. There's going to be a comment period. This is just a proposal. This is not a law. But it really is going to invalidate what blockchain offers. So I don't think we'll ever see this in action personally. But it'd be really interesting to see what comes out in the next 30 to 60 days from the comments, because it really does invalidate so much of what blockchain is. So anyway, long story short is, there's reasons why this rally is real. There's also places where growth is really happening. We are constantly seeing areas of the market where you're seeing real growth, right? Blur, for example, in the NFT space. OpenSea had a pretty dominant market share in NFT trading, as much as 6 months ago. And then you saw players like LooksRare and X2Y2 come out. And now you have Blur, right? I mean, Blur is doing 3 times the volume of OpenSea today, largely because of the incentives of the airdrop of their new Blur token. As a result of that, you're seeing ETH get even more and more deflationary because of all the volumes that are happening. So you go down the list, and there's real activity, there's real volumes, there's real things happening in the space. And, on top of that, you now have, potentially a lot more money and interest flowing out of Asia into this space. So we'll see what happens over the next, couple weeks and next couple months and into the rest of the year here. But I don't think this is a rally to be faded. I think there is definitely some real reasons for it, and we'll see what happens. So that's it for this week. Appreciate everyone listening and reading the blog. You can catch us on our website at ar.ca. You can catch us on Twitter, and we'll be back again next week. So that's our 2 Satoshis. Thanks, everybody.